In terms of parameter estimation, there are a few methodologies. The first methodology is personally the one I prefer, because you have a tendency to understand much better what you are doing. But basically, you use sequential estimation in order to achieve your goal. And by sequential estimation, I mean that so in the Cointelation model, you have a few parameters. So let's write it down here. So in here, I will put root dwt plus 1 minus rho squared dwt independent. So you have few parameters here. So you want to make sure you have estimated this guy and you have estimated this guy. And the way to do this is to do them sequentially. So this row appears here as well. So what you try to do first is to estimate this row parameter here first. And this is just the expectation of row 1. Now, this is the hard one. So sort of the speed of mean reversion. If you rearrange your stochastic differential equations so as to isolate theta, you have the problem which is sort of ubiquitous when it comes to trying to assess the estimate of the Einstein-Uhlenbeck model. So if you have tried to fit the Einstein-Uhlenbeck model, you have encountered this problem before. But basically, the idea is that it is very, very difficult to estimate it just directly by rearranging. You have to use some sort of variance reduction techniques. And this is achieved by sort of creating bands around your spread. So if in black here you have sort of the spread between these two underliers, then you can define two zones. You have a blue zone here. So the blue zone in here, which is this zone plus this zone. So let's call this Z here and ZE here. I forgot why I chose, oh, it's not E, it's theta. I was wondering what the E meant, but there's a theta here. So this is the zone in which you estimate theta. And the last zone, the second zone here in green, is where you estimate your theta. So basically, the idea is that in these blue regions, in here, here, and here, these guys are significantly different from each other, that the deterministic side of the differential equation takes the ascendant over the stochastic part. So the quality of your data in the blue region, as to when it comes to assessing the theta parameter, is much higher. So whenever you estimate these, the theta parameter using this formula here, you want to make sure you do it in these zones. And this is just a very simple variance reduction technique that you can use in order to achieve this goal. And vice versa for this zone in order to estimate the volatility of departure of your stochastic differential equation. Now, how do you define these two bands? A very, very simple way to do that is to assume that if this is mu, okay, and if this is the max in here, halfway between these two things, then you have B plus. And similarly, if this is your min, halfway through between your min and your max, you have B minus. Okay? now there's a second methodology here, is to rearrange the inferred correlation formula. So if you remember in here, this is the inferred correlation formula. And if you were to rearrange the parameters such that you isolate this theta here, then you have the theta parameter here, which is approximatively equal to this guy. So this is another way to estimate the theta parameter. You can do something similar with the number of crosses here, although this is a little bit more unstable. And then at the end, what you really can do is to use the three estimators that you've estimated in the previous three sort of sections, and then you know your f function is just a way to maximize the quality of your data here, which can be studied in the original papers if you're interested in parameter estimation. Okay, so now let's take a look at a couple of examples. So the example of oil and BP. For the example of oil and BP, you can already sort of see the qualitative reasons why oil and BP are very good candidates when it comes to evaluating relationship between assets, you know, which have some sort of physical connections. Obviously, BP is in the equities market, oil is in the commodities market, but BP is an equity which heavily relies on the price of oil, so there must be some sort of physical connection between these two things. And this is a plot between oil in blue here and in red, the price of BP from the 23rd of April 2007. So in here you have we have plotted the max function in here in blue, and we have also plotted the soup function after estimating the parameters of the Cointelation model, and we can sort of see that the max and the soup function are very, very close to each other. So the very first sort of point of the definition is sort of verified. You can sort of do the same thing with Walmart and Target. Obviously, Walmart and Target are within the same sectors. People who work in pairs trading have, I'm sure, seen this example in the past and have put strategies in the market related to this concept of relative value, and they would understand what I mean. And here again, the expectation of the soup really fits well the max function, and you can try this for yourself if you want to verify it. This is a very good example as well. So from now we have talked about measured correlation, inferred correlation. So measured correlation is the correlation you measure, or the historical correlation. Inferred correlation is the mirror of the Cointelation model. And implied correlation is the correlation that you get by reversing sort of the Black-Scholes model and seeing what it gives you. So basically, so for confidentiality reasons, I wasn't able to tell you what X and Y here are. But because these are taken from the market, but the idea is that X and Y are cointellated, and what you can sort of see is that as the ratio between X and Y changes, so you have some sort of long-term mean for or sort of some sort of equilibrium mean between X and Y. And you can sort of see that whenever Y or X is significantly bigger than Y, or when Y is significantly bigger than X, then you can sort of see some sort of oval shape or circle shape appearing here, which suggests that traders already have priced in their head the concept of mean reversion in the market. So, and this is what you're sort of seeing. So the closer the implied correlation is to this ratio, the higher the correlation, and the bigger the spread between these two things, the smaller the implied correlation. This is because the traders expect some sort of correction to occur in these zones here and maybe here, and have a tendency to price correlation a bit lower than what it ought to be in this region. So in terms of applications, there are a few applications that we'll take a look at in the next few slides. In terms of measuring risk in short and long term, we can use the Cointelation model. In terms of stress VAR, in terms of portfolio construction, and we'll see last proper market conduct. So in terms of measuring risk in the long run with only short-term data, imagine you're assigned a task to measure the yearly correlation of some sort of equity which has only 2 years of historical data. Obviously, you cannot do this because you would need at least maybe 30, 40 years of data in order to have some sort of stable correlation estimate. But good news, you can use the Cointelation model and then sort of estimate the theta and the sort of rho parameter at the most infinitesimal level, and then extrapolate, thanks to the inferred correlation formula, what the yearly correlation, the conservative yearly correlation ought to be. So it's quite useful when you don't have much data. I will not delve into this slide here. You can take a look at it, but basically, yeah, I'm not a big fan of this slide, but some people believe that correlation should diminish as well, and this is just a way to correct the inferred correlation formula in order to have it decrease as well. But I think it's quite dangerous, and if you do something like this, you might make your manager happy because you can achieve goals, the goals that he wants or she wants, but you're not really doing proper, I guess, proper quant work, I guess. So in terms of stress VAR and capital requirements, obviously there are quite a lot of I get projects around capital requirement these days, especially within the challenging regulatory environments. And one of the things that you can do is when you calculate VAR or stress VAR, you need to come up with a conservative approach to measuring correlation, especially if you're trying to assess the VAR of a portfolio. Then you can use the inferred correlation formula in order to achieve this goal. In terms of portfolio construction as well, so the 101 of portfolio construction is trying to assess what the volatility will be and what the correlation between your different assets will be, as well as obviously the expected returns of the stocks or the underliers you have picked in order to construct your portfolio. But obviously, especially if you're dealing with other people's money, you want to make sure that you take a conservative approach and that in the worst case scenario, you're not taking risks that your client doesn't want you to take. So you can use the inferred correlation formula in order to come up with some sort of conservative approach to building your portfolio. And the last section is on misleading statement and actions, an example. Especially since the last crisis, you might have noticed that the FCA and the SEC has had much more stringent approach when it comes to evaluating whether a statement is misleading and whether a banker is really following the client best interest rule. And the following example is something around the concept of correlation and the misleading statement and action concept as defined by the FCA. So imagine you're a commodities salesperson. You have only a mandate to sell commodities. So for example, oil would be an example of commodity. In order to attract investors or like investors for your product, then you need to show that your products are a great way or a good way to diversify for your clients. And in order to do that, so diversification is a key here, and you want to show a low correlation between your products, the products that you're selling, and the product that your client already has in his portfolio. So what you can say is say, oh look, historically oil and BP have had very, very low correlation. Therefore, if you're a long-term investor, you might want to buy oil as well in order to diversify your portfolio. But then the question is, in order to justify how low the correlation is, which time scale do you use? And this is where the misleading statement and action rule comes into play. And this is a simple plot in order to expose some of the misconducts that I have witnessed in the financial industry. Basically, you could take the naive approach, especially if we're talking about a long-term investors. Usually, an investor which buys commodity from a top commodities desk is not going to do that for a one-day sort of. It's not a one-day thing. It's usually they buy commodities for the long run, so they want to keep these commodities at least for a few months, 6 months, a year. Depending on the type of investor. But if you don't have the measured correlation on a yearly basis, what correlation do you return to your investors? So the naive approach here in orange, so I put it in orange because this is not the worst thing that you can do. The naive approach is to say, well, I'm just going to take as much point as possible and use daily correlation in order to achieve a good stable measured correlation. So you have a one-day sort of measured correlation here, and you return this to your client. But the problem here is that you know that there's some sort of physical connections between BP and oil. You know that in the long run, especially in times of crisis, everybody knows that in times of crisis, the correlation, everything goes to 1, everything crashes. So you might not have an as diversified portfolio as you may think. The worst thing that you can do, and this is why it is in red here, so this is the most misleading thing that you can do, is to ask one of your quants, dear quant, please return me the minimum correlation possible. I really need to show a very low correlation to these clients. They're not convinced that they will have a more diversified portfolio. In order to achieve this, I need to show them a very low correlation. So your quant, what he's going to do is to take a look at the measured correlation at different time scales here, and then he's going to notice that the lowest correlation that he can achieve here is, let's say, something around between 35 and let's say 37. So I don't know, maybe 36, 37. Let's say 36.5. And then you're going to see that this is achieved for maybe 12 days return. Then what you're going to do is that you're going to give to your client saying, oh, look, the correlation between oil and BP is quite small. And you're going to hope that they're not going to ask you what time scale you have used in order to return that low correlation number. And this is where this is what I mean by the most misleading sort of approach. A better approach, in my opinion, especially if the client did not intend to invest in commodities, is to give them a conservative sort of approach to correlation. So for example, if they believe, or if their sort of time scale for investment is 70 days, then you might want to return the sort of the correlation or the inferred correlation again. So this is where the inferred correlation value can come into play. You can tell them, well, it is true that you know, there are some sort of physical reasons why BP and oil are sort of related to each other, but even with the inferred correlation sort of formula, for the time scale that you want, you still have maybe a correlation of 0.55, which may appear as, although not great, could diversify a little bit. But in my opinion, you shouldn't really at least use correlation when it comes to trying to make your commodities product attractive to the equities market, because of these sort of physical connections between commodities and equities. So yeah, to sort of clarify, so why is 12 days the optimal return time scale? Why not 11? Why not 13? 12 is the result of the minimization problem, which aims at returning the minimum possible correlation given a time scale. So a client who has a poor understanding of correlation may be enticed to buy products you're not really interested in, and which is not in his best interest. So what you have essentially done here is how to, by using this minimization algorithm, you have really essentially done research on how to best mislead your client. And especially if you use arguments like the Gulf of Mexico sort of event, which is a textbook sophistry, because we're not talking about causality here, but we're talking about correlation. The question is not whether there's a causality sort of relationship between the relationship of oil and BP, because this is obviously not the case, but the question is to what extent correlation is important between BP and oil. So now, breach of statutory duty. So as you might be aware of, any financial sort of big, serious financial institution in the UK is authorized. So authorized is a keyword which essentially means that you are regulated by the FCA. And if you breach the rules laid out by the FCA, for example, the client's best interest rule, or the rule on misleading statement and actions, if you breach these rules, then there's a breach of statutory duty. And there's huge consequences in terms of liability. Basically, so this is a bit of a verbose way of saying what I'm going to say next. But the idea is that if you're a client, you've been sort of lured into buying commodities from, you know, a commodities desk, and you've done that through an authorized firm via an FSA or FCA approved person, then you know you can sue the company basically, especially if you have lost money, in order to recuperate some of the money that you have lost. So there's a huge incentives for the banks at the moment to prevent the popularization of the inferred correlation concept. So if you're a salesman, please be aware of these practices, and if you're a client, please be aware of these practices as well. And that concludes the presentation. Feel free to download the relevant papers and send me questions if you have any. My contact information is at the very beginning of of the slides. And thank you very much.